Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
After 12 days of hostilities, President Trump announced a ceasefire in the war between Israel and Iran. Markets reacted swiftly. Oil prices plunged 12% in 2 days, the dollar and gold both slipped, and global stocks rallied.
But as investors shrug off geopolitical tensions, are they underestimating the risks? And in today's dumb question of the week, can you buy oil? All right, let's get into it. So unless you've been living under a rock for the last week, you will have probably noticed a major war in the Middle East between Israel and Iran, and then the US got involved. And I guess even if you were living under a rock, the US may have got to you with their bunker buster bombs. Now, this is a treacherous topic to talk about for a few reasons. One, it's very easy to annoy people with whatever you say, so we're going to stick to the market reaction as much as possible. And two, whatever we say will inevitably be out of date by the time you listen to this. So we're recording on the morning of Tuesday, the 24th of June, and we're waking up to the announcement of a ceasefire between Israel and Iran, which Trump announced in the night. We'll have to see whether that holds. But Roman, up to now, if you've just been watching the stock market, you wouldn't have really got a sense that there's this turmoil in the world. Were you surprised by the sort of lack of reaction in stock markets?
Not really. I think this is often the way. And I think it is a little bit cynical of markets, which is that all they focus on is profits. And given the size of US markets, what's most important is profits for US companies. So the question is this going to negatively impact the profits of, say, Microsoft, Nvidia, and so on? And the answer is no. So I think that's a kind of rational response that we've seen from US markets at least. Other markets have reacted. We have seen fluctuations in the value of the dollar, oil, of course, but those have been fairly short-lived.
I suppose what markets were really looking out for was, is there going to be an energy shock or an oil shock? This is what everyone watches for in Middle Eastern wars. And analysts were falling over themselves to point out that Iran has a lot of leverage when it comes to the global oil trade because they control this very important strait, which lies between them and Oman. And a lot of oil is shipped through that strait.
Yeah, I had a friend who went on holiday in Oman, and he was saying he was sitting on the beach, and literally you can look across the strait and see Iran on the other side, which at the time was not such a big worry as it would be today.
Yeah, I wouldn't sit on that beach now watching the oil tankers. Because they've left them alone for now, but you never quite know. I saw a funny tweet from Javier Blas this morning, the energy correspondent for Bloomberg. He said, "That sound you hear this morning is an industrial-grade shredder taking care of all the closure of Strait of Hormuz oil analysis."
All those poor strategists, they thought they were going to be the star of the next vote for the best analyst, but it turns out that's not going to happen. And they got very excited about this potential spike in the price of oil due to the closure of the Strait of Hormuz, but that clearly hasn't happened so far at least. But I think markets are getting a little bit ahead of themselves and a little bit complacent, given that these kind of conflicts tend to blow up repeatedly.
And it is a significant choke point in the shipment of global oil. Something like 20% of global oil flows go through that strait. But then a lot of people have said, well, Iran would be shooting itself in the foot somewhat, given that it would impact its own oil sales. And its biggest customer is China, who wouldn't be happy. It's not like a direct impact on the West, although we would pay as global prices rose.
Yeah, maybe it's a good thing to step back a little bit here and talk about oil and how it affects markets. Now, for the US, they've largely become self-sufficient in oil because of shale oil, and that's been a huge benefit to them. So if we go back to the 1970s, when they went through an awful crisis, they were heavily dependent on oil being shipped from Saudi. Whereas recently, I think it was just a few days ago, they actually shipped no oil from Saudi Arabia at all. So I think that's what's going to be good for the US this time around. And that also explains why a higher price of oil is actually good for a large chunk of the US economy, which wasn't true in the past. For other countries, however, it's a real problem if the oil price spikes. For example, the UK, we're heavily dependent on oil imports. To first order, we import oil and we export services. So a higher oil price is really awful for the UK economy.
I mean, Trump certainly doesn't want a higher oil price. He keeps tweeting about how the price needs to come down at the pump. And I don't think he quite understands there's this dynamic in the market where a higher oil price incentivizes production in the US, like more shale producers become commercially viable. Whereas if the price falls, that's less so. There's like this self-correcting mechanism.
And it's all down to how much it costs to pump oil out of the ground. In Saudi Arabia, they're incredibly lucky because basically this stuff is really cheap to pump out of the ground.
Don't even have to pump it, just sort of like stick a spade in, you've got loads of oil.
Whereas if you look at the US, their break-even point for the price of oil to be profitable is much higher. So if it's much less than about $60 a barrel, then it's a problem. There's a secondary effect in oil-producing Middle Eastern countries, which is their fiscal position, which is how much profit they make from selling oil, directly impacts whether they can balance their books. So a falling oil price can be a problem for them. But certainly in terms of the amount it costs to pump it out of the ground, it's much lower in Saudi than it is in the US. And there are other countries which are heavily dependent on energy imports. So that would be much of Europe, Japan, and of course China.
And although we said stock markets have basically shrugged off what's been going on in the Middle East, that's not true of oil. The oil price spiked relatively significantly when Israel commenced hostilities with Iran, and took another leg up when America got involved. But then weirdly, when Iran responded with ballistic missiles at the US base in Qatar, the oil price crashed. Like usually, ballistic missiles are not a good sign. But here, the market was relieved that, well, at least they're not going after tankers in the Strait of Hormuz. This looks like a kind of symbolic response.
Yeah, Trump's comments about this were interesting. He said it was a very weak response to the obliteration of Iran's nuclear facilities by the US over the weekend. And he said, they've gotten it all out of their system and there will hopefully be no further hate in capitals. And he thanked Tehran for giving us early notice, which made it possible for no lives to be lost.
I guess the question is, have both sides got it all out of their system? Is this ceasefire going to hold? And the next question on my notes is, how could the situation get worse?
Well, it just did.
What?
Just as we're recording this.
Do I need to open another browser tab? What's going on?
So Israel says Iran has violated ceasefire and vows retaliation. There we go.
Well, now I can see Iran denies firing missile at Israel, just breaking on the BBC. So I guess as we're recording this, it's probably going to be the state of the world for the next few days anyway. No one's going to know whether this is going to hold. Markets, I guess, will be volatile.
Yeah, I think that's inevitable. So you asked if this could get worse, and I think the answer is yes, it could. And I think it's likely to. This is going to drag on for a long time. Israel sees Iran as an existential threat, and Iran is worried about things like regime change being imposed on it due to the attacks from the US and Israel.
I always wonder about what the next step's going to be. Like, let's assume that the US has set back Iran's nuclear program significantly and they can't build a bomb imminently. Let's assume that to be true. You're still going to need some sort of diplomatic agreement around regulating what Iran can do regarding enrichment of uranium. They seem unwilling to give up that right as it stands. And apparently they still have 400 kilograms of uranium enriched to 60%, which is just short of nuclear weapons grade. That's still around somewhere, apparently. All of this stuff is going to need to be hammered out around the negotiating table with the US, even if we assume that the ceasefire lasts.
Yeah, these problems are not going to go away. And the only solution ultimately is going to be diplomatic. So I think that there's too much complacency at the moment about talking about a ceasefire. And I don't think this is going to be a conflict that ends probably in my lifetime.
But even if that's true, does what you said at the start still hold that stock markets are going to be unperturbed by this, unless there's some severe escalation?
Yeah, and it all comes down to energy, I think. Ultimately, it's going to be a question of how quickly can we shift to renewable energy and make these conflicts in the Middle East much less important for the global economy. And I think that's actually one of the catalysts for speeding up that transition, because if we see that we are so heavily dependent, which we are, on energy, particularly in the UK, then it makes absolute sense to start to move to a source of energy which doesn't depend on what's going on in the Middle East.
Yeah, because all this stuff doesn't affect corporate earnings until it does, right? There is a way that events spiral and major powers get involved and the price of oil goes way up beyond what the market can bear. And then, of course, the input costs go up for companies. And we've seen in the past how oil shocks can play out. It's not perhaps the most likely scenario, but it is always possible. That's why people have tail risk hedges.
And the Bank of England was talking about this. They were talking in the minutes of their recent MPC meeting about geopolitical risks. And of course, for the UK, the big one is energy prices, particularly gas prices, because we're so heavily dependent on gas for heating our houses, but also for energy generation, which isn't renewable. Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and the lowest FX fees I could find on the market. Looking to keep things simple, you can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. Customers with Invest accounts can also benefit from the Trading 212 card, which has no FX fees, true interbank rates, and offers 1% cashback on all transactions up to £20 per month. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1 and use the promo code RAMIN. That's RAMIN within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You are responsible for all investment and rebalancing decisions. Free shares can be fractional. 212 cards are issued by Paynetics, which provide all payment services. Trading 212 provides customer support and user interface. Terms and fees apply.
Now, I know the last thing anyone wants in this world is to hear the geopolitical analysis of a couple of podcasters, but we probably have to humour ourselves. So I was wondering, are there long-term implications of this kind of thing? Especially with America now wielding its military might again. Has this emboldened Trump to start being more forceful around the world? Like, he ran on this ticket of, I'm going to end war. Doesn't seem to be happening so far. And then are there further consequences? Like, will Russia and China now be like, well, all bets are off. International laws and rules don't apply. Even the US is sort of not even pretending to stick by them. What does that mean for Taiwan and everything like that?
I think that's the worry, and I think the focus is now very much on what's going on in the Middle East, and so perhaps China will be emboldened to do something with Taiwan. Certainly one of the accounts I follow on Blue Sky is the Japan Times, and they were talking about how focus has now shifted away from the Pacific region, where Trump had actually pledged he was going to focus his attention.
There's so many things in the world that need our attention right now. We've got war in Europe, we've got war in the Middle East. We're probably going to have a war in the Pacific at some point. And it seems we can only ever focus on one thing at one time, right? Everyone's forgotten about this trade war that's going on in the background. Let me remind you that apparently the 8th of July, that's 2 weeks' time, is the deadline for when Trump has said these trade deals must be agreed or my massive tariffs come back in. Is the market going to start remembering that soon?
I think it will. And if you were cynical, you could say, well, this bombing actually happened just before that kicked in. So maybe those two facts are related.
I think the market is assuming that those tariffs will not come into effect and will be delayed once again. But you never know with Trump. You really never know.
And casting our minds back to that frame of mind before the Israel-Iran conflict, the other big concern was what Trump was talking about to do with the Fed and whether it could remain independent. There was lots of commentary about firing Powell. There was a lot of commentary about him thinking that rates should be 2 percentage points lower and how Powell was always late. And recently he joked to journalists, can I be appointed to the Fed?
Right, yeah. He was joking.
Yeah, let's hope so.
I mean, we are starting to see some of the FOMC members at the Fed coming out and saying that, maybe we should be cutting rates now. So I see that today Michelle Bowman said that. Maybe as soon as July.
Yeah, look, if you're interviewing for the job of Fed chair, you're going to come out and say, oh, yeah, I think we should cut rates maybe by 2 percentage points. You know, that would be a smart
She didn't
move.
say that.
No, she didn't say that. And Fed Governor Christopher Waller also said recently that he supported rate cuts as early as July.
you think Trump's going to get his way then? Is Powell going to get outvoted? That hardly ever happens to a Fed chair.
Yeah, but they're all gunning for his job now. Christopher Waller, for example, is a contender to succeed him. So maybe there will be more dissent now, which I think wouldn't necessarily be a bad thing for the Fed.
It's always unanimous, Fed decisions, or almost always. Sometimes you get a lone person voting in a different way, but they always manufacture a kind of unanimity across the board.
Yeah, you can tell a lot of chat goes on before the meeting. They have a consensus and then they have the meeting. What they really need is a big ding-dong.
It is hard to know what they should do right now because we don't know what's going to happen with inflation.
Yeah, we haven't seen the effect of the tariffs kicking in and actually showing itself in the inflation data because these things happen with a lag. We haven't seen the effect on growth and employment, but we will start to see that in the months ahead, and that's going to be fascinating.
Because Trump said that he kind of accepts that point, but cut rates now, like they've done in Europe, and then if inflation comes back, put them back up again. I actually don't really disagree with Trump there. I don't mind moving the policy rate around a little bit more. I don't think you need these long cycles.
Yeah, maybe. I mean, who knows what's right? I just assume that the Fed has actually thought through that scenario and has decided it's more important to have credibility, i.e. if you're flipping rates around day to day, then that's more of a difficult thing to plan around than a Fed which gradually reduces rates.
Yeah, and I think it's also the fact that central banks tend to make their decisions on what is kind of most expedient or at least least likely to get them into trouble. And here you'd say that with inflation having been really high in the recent past, the danger is you ease up too early, inflation spikes, and everyone goes, the stupid Fed cut rates. But Trump is pushing so hard now in the other direction of saying slash rates now that the political blowback is kind of evened up. So you don't know which way to go. Even if you don't care about making the right decision, you just want an easy life, you still don't know what to do.
So let's hope the government's response isn't to preempt what the Fed does by introducing something crazy like century bonds.
So we've touched on so many things here, which are in a state of flux. We've got wars going on around the world, which all have the potential to escalate. And they're between strategically important countries, some of which control a lot of oil, like Russia, like Iran. We've got a trade war that's simmering and potentially about to blow up again. And even if it doesn't, we're going to have higher tariffs than we had before. And we've got a Fed that doesn't know what to do, justifiably. What should we do about all this as investors? The world is uncertain.
Well, that's always true. And I think if your plan doesn't allow for these pullbacks in markets, that's a problem. Because you should assume they're going to happen. I think what's true is that you never know the cause of it, and you can never trade around it because you won't be able to time it correctly. But you should have as part of your plan the understanding that equity markets will pull back by 40% for whatever reason at some point in time. I don't think this is going to be the catalyst for it, but I think eventually there will be a catalyst for it.
Do you even need a catalyst? I feel that sometimes bubbles just get so big they pop. Like it's the internal pressure of stretched valuations which pop themselves. Like the dot-com bubble didn't have an external trigger. It just sort of popped around the year 2000 because it had got too big.
Yeah, I guess if you do live in this alternative reality where profits don't matter, eventually reality is going to reassert itself. And I think that's also true for US equity valuations. Eventually there will be a correction. And it will be huge because, a lot of equities in the US are hugely overvalued.
I mean, I saw you did a video on YouTube which said that we are in a bubble, controversially. Like, it's really hard to call a bubble in real time. You've nailed your colours to the mast and said US stocks are in a bubble.
Oh, yeah, I definitely think they're in a bubble. And I don't think this is a new normal. I think that things will mean revert. Eventually, some other country's going to come to the fore. It'll take many years. But you're right, you can only see these bubbles in retrospect. But there's no question, if you look at valuations in the US, look at how much profit the Magnificent Seven generate relative to the S&P 500. So these companies make up about a third of the S&P 500 in terms of market cap, but they only make up a fifth of the profits and about 12% of the revenues because of their high margins. So that means they're overpriced. Egregiously overpriced. And all it takes is people realizing that and that story finally filtering through in order to get a correction back to something more reasonable.
Yeah, but Romin, you're a funny kind of strategist because you say we're in a bubble, but don't do anything about it. Just hold on.
And that's because of timing, right? You've got to get these things correct. If you are going to pull back and dial down the US exposure, you've got to do it at the right time. And then you've got to decide when to get back in. So I think I can't time those things. So while I do think we're in a bubble, I'm not doing anything about it. I've still got my global equity allocation, which is huge, and I'm sticking with it. So if you're worried about what's going on in the news, then perhaps you'd like to join our membership and discuss that with other members of our community and see what they're doing. Plus for June, we've got a special offer where you get 75% off your first month's subscription. Just use the code SAVE75 at checkout, and you can do that when you go to our website, pensioncraft.com/membership.
Okay, today's dumb question of the week is, can you buy oil? Now, without wanting to state the obvious, we're talking about crude oil here. Can you buy it? How would you buy it, Romin?
Well, you can buy exposure to oil, but it's not direct, it's indirect via the futures market. And this is something that often confuses people about commodity funds, which is that you go via the futures market, and futures are tricky to understand. You have to understand things like the shape of the futures curve. Is it upward sloping or downward sloping as you get further out into time with your contracts?
All right, for anyone new to this, what are futures?
Okay, so there's the spot market, which is if you go out and you're an institutional investor to buy oil in the market today, you pay the spot price. And you can literally get oil shipped onto your dock somewhere in the world. But for investors, you get exposure to oil via the futures market. So that's a contract that you buy or sell, which agrees to delivery of oil at a specific time. So that's the point in future. And it also specifies the quality of the oil, which is very important, and also the delivery point, because that also affects the price. And because of that standardization, it's very easy to price the contract.
And to trade the contracts. But you scared me there. You said the word delivery. If I buy one of these futures and I hold it to the expiration date, am I going to have a load of barrels of oil in my garden? What's going on here?
Yeah, but as a retail investor, you never buy the futures contract itself. You buy a fund which buys the futures contract, and they just roll the contract, right? So as one's about to expire, they buy the next month maturity or whatever. They're often quite complex schemes for how they choose the maturities to reduce something called roll cost, because they continue having to buy and sell these contracts. So you try and minimize that cost.
I remember looking at how to trade oil on one of the investment platforms and reading the brilliant sentence, "With us, you won't have to deliver or take delivery of any physical barrels of oil," as if that was going to reassure me.
But the thing to remember is this is not just some airy-fairy theoretical thing. If you hold the contract to maturity, oil will be delivered to that place at that time.
With your name on it.
With your name on it. So you better be ready. Don't say we didn't warn you. And that's not a recommendation to buy oil.
This is how we got that weird situation in COVID where demand slumped across the world. People didn't need so much oil, and there was loads of it on boats and stuck in pipelines or whatever. And the oil price in the futures market actually went negative because there weren't enough places to store the oil. So if you had one of these futures contracts, you kind of had to pay someone to take it off your hands because you didn't have anywhere to put it.
Yes, we got a very exciting situation called super contango. But yeah, the price of oil went negative. So that was a very weird situation where you had to pay people to take delivery.
First time it's ever happened, I think. Warren Buffett said, if you live long enough and watch markets for long enough, you will see everything.
But look, oil is important. And for example, one of the things I've been playing around with in my fund portfolio recently is a kind of levered 60-40. And a big slug of that portfolio is broad commodity exposure, of which a very old slug is oil exposure. Because historically, if you look at the back test, when you get these oil spikes, it's good to have that protection in your portfolio.
So if you live in Holmer Green and you see a load of barrels stacked up in someone's back garden, Romin's done something very wrong with managing his risk. Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a Pensioncraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.